Welcome to the Deep Dive. We cut through the noise to help you get properly informed. Today, we're taking a deep dive into Palantir Technologies, ticker's PLTR. Now, this company, it's a serious player in the AI space, and honestly, their recent performance, it's been pretty spectacular. But, and this is the big but we need to unpack, does that amazing run justify what, frankly, looks like an extremely demanding valuation? So our plan today is to really pull apart their latest Q2 2025 numbers, get a solid handle on Palantir's, unique business model, look squarely at the risks involved, and then this is the really interesting part. We're going to put Palantir through a specific test. Warren Buffett's investment principles. We've got some great sources lined up for you.
Exactly. The goal here is to help you understand not just what they're up to, but really why it matters, especially if you're tracking how this cutting-edge tech intersects with more traditional investing ideas. And understanding these fundamentals is key. For listeners interested in tracking broader market signals, especially value signals, there are tools out there, like the Buffett Indicator iOS app, which can give you that kind of macro view. It helps put companies like Palantir in context.
Okay, let's jump straight into those Q2 2025 results because, wow, they really do feel like a bit of a paradigm shift for Palantir. For the first time, their quarterly revenue crossed the $1 billion mark, landed at $1.004 billion.
Yeah, it's huge.
That's a 48% jump year over year, well ahead of what analysts expected. And adjusted EPS, 0.0016 cents, also a comfortable beat. What really jumps out at you from these numbers?
For me, it's the engine behind that headline number, specifically the U.S. commercial segment. It grew an incredible 93%, hitting $306 million. That's just astonishing. It really validates their whole strategy of moving beyond just government work, Shows they're making serious inroads into corporate America. That acceleration is key.
So it's not just government anymore.
Not at all. Though their U.S. government revenue is still very strong, grew 53% to $426 million. So, firing on both cylinders, really.
Okay, so growth across the board. Now, for software companies, there's this metric, the rule of 40. You basically add the revenue growth rate and the adjusted operating margin. Over 40 is considered pretty elite. Palantir's score, 94. That's based on their 48% revenue growth and a 46% adjusted operating margin. What does a rule of 94 actually tell us?
Well, it screams efficiency, doesn't it? It means they're achieving that super fast growth, and they're incredibly profitable at the same time. For years, the knock on Palantir was, they're just glorified consultants, super high-cost deployments. A rule of 94 basically blows that argument out of the water. It suggests they've really productized their platform, moving towards a true, scalable SaaS model.
Right, less reliance on armies of engineers for each customer.
Exactly. And look at the adjusted free cash flow, $569 million in the quarter. That's a 57% FCF margin. Just phenomenal cash generation. It implies that their AI platform, AIP, is really working, letting them deploy faster and more efficiently. It's productizing the magic, essentially.
And management seems to feel pretty good about it, too. Their tone was very confident. They significantly boosted their full-year guidance for 2025. Revenue now expected between $4.142 and $4.150 billion, and free cash flow between $1.8 and $2.0 billion. That signals real confidence and sustainable momentum, right? They must see a strong pipeline.
Absolutely. That kind of guidance hike isn't trivial.
Okay, so we've seen the impressive numbers. Let's switch gears a bit. What exactly is Palantir? What do they do? I know the origin story is kind of interesting. 2003, CIA backing through in QTEL, originally trying to adapt fraud tech for counterterrorism.
That's the gist of it, yeah.
Yeah.
They built out from there, really centered around three core platforms now. First, there's Palantir Gotham. That's their original government platform. Think defense, intelligence, law enforcement. It's all about integrating massive, messy data sets to find threats, connect dots, basically make sense of chaos and high-stakes situations.
Okay, the government side.
Then there's Palantir Foundry. This one's for the commercial world, for businesses. Foundry acts like a central nervous system for a company's data. It breaks down those data silos everyone talks about, creates a single live picture of the entire operation. Companies use it to optimize supply chains, speed up R&D, improve manufacturing, you name it, across tons of different industries.
So integrating everything for businesses.
Right. And then the newest piece, which is really driving a lot of the excitement, is the artificial intelligence platform, or AIP. AIP kind of sits on top of Gotham and Foundry. It lets organizations securely deploy things like large language models, the tech behind ChatGPT and other AI tools on their own private data. This is huge. It moves companies from just analyzing data to actually automating actions and building real AI-powered applications. That's the engine behind this recent growth spurt. Think AI agents inside a company actually doing things, not just reporting.
And their sales approach seems quite unique, too. I've read about these boot camps or AIP conferences. It sounds like they go in, tackle a client's problem quickly, and show value almost immediately, like within days.
Yeah, it's very hands-on. They basically say, give us your toughest data challenge. We'll show you how AIP solves it right now. It's incredibly effective. It often leads directly to those multi-year, multi-million-dollar deals because clients see the potential firsthand very quickly.
Makes sense. Like a try before you buy, but on steroids.
Pretty much. And you see it in their customer growth. As of Q2, they had 849 total customers, up 43% year over year. Breaking that down, it's 692 commercial customers. That's up 48%, and 157 government, up 25%. But the really key number strategically is the U.S. commercial customer count, up 64% year over year to 485 customers.
That's rapid growth, and it reduces the reliance on government contracts, I suppose?
Exactly. It de-risks the business profile significantly, taps into that huge U.S. enterprise market. And they're signing bigger deals, too. They booked a record $2.27 billion in total contract value in Q2, including 157 deals worth over $1 million each. Shows real momentum in landing significant contracts.
Okay, so performance is strong, the tech sounds powerful, customer growth is accelerating, but now we have to talk about the elephant in the room, the valuation. Let's just put the numbers out there. Trailing PE ratio, over 600. Price to sales, over 100. I mean, let's be honest, those are extreme numbers. It feels like the market is pricing this thing for absolute perfection, doesn't it?
It really does. And that's the primary short-term risk, without a doubt, the valuation risk. If growth slows even a little, or if they miss expectations, well, a stock price like this could correct very sharply. Palantir is known for its volatility. We've seen 20–30% drops before, multiple times.
Right. So high expectations mean high risk of disappointment.
Precisely. Plus, you've got economic sensitivity. A bad recession could definitely hit that commercial growth.
Yeah.
And government spending is always subject to politics, budget cycles, potential shutdowns, things outside their control.
Okay, those are the near-term headwinds. What about longer-term risk? What could potentially derail them down the road?
Well, competition is fierce, and it's only getting fiercer. You've got the public cloud giants, AWS, Azure, Google Cloud, all pushing their own data and AI tools. Then there are specialized players like Snowflake in the data warehousing space, and the big IT consulting firms Accenture, Deloitte, who already have deep hooks into large enterprises.
So they're fighting on multiple fronts.
Definitely. Another point that sometimes comes up is reputational risk. Their work with intelligence agencies, law enforcement, immigration. It's controversial for some. That could potentially put off some commercial clients or even make it harder to recruit top tech talent who might have ethical concerns. It's something to be aware of.
And the voting structure.
Ah, yes. The multi-class stock structure. It basically concentrates voting power with the founders Peter Thiel, Alex Karp, Stephen Cohen. Public shareholders have very limited say in governance.
Okay. And briefly, what about their costs? What drives their spending?
Pretty standard for a tech company, really. Big buckets are sales and marketing, G&A, and R&D. Historically, a big chunk of that, and a point of criticism, was stock-based compensation, SBC. Paying employees with stock.
Right, that can dilute shareholders and mask true profitability.
It can, but the good news for bulls is that while SBC is still significant, it's been shrinking as a percentage of revenue. That's actually a key reason they've recently become GAAP profitable. Other than personnel, cloud hosting costs are a big variable expense. More customers, more data, more compute power needed. Those costs scale up with usage.
All right, now for the really interesting part. Putting Palantir through the Warren Buffett lens, applying his value investing principles. This usually highlights a pretty stark contrast, doesn't it, between growth investing excitement and, well, value investing discipline.
It certainly does. Running Palantir through Buffett's key tests really crystallizes why it's such a divisive stock. Let's break it down. Okay, first hurdle, valuation discipline. Buffett wants a low PE, ideally 15 or less.
Yeah.
Low price to book, maybe 1.5 or less. He needs that margin of safety.
Buying a dollar for 50 cents, basically?
Exactly. Palantir's PE is around 698. PB is nearly 69. So that's a hard fail. By Buffett standards, there's zero margin of safety here. The price assumes flawless execution far into the future. No room for error.
Okay, not a great start on the value front. What about cash generation and allocation? Buffett likes consistent positive free cash flow, FCF margin over 5%.
Here, Palantir actually looks much better, especially recently. They were burning cash before going public, but since 2021, they've generated strong, positive FCF. Their trailing 12-month FCF margin is around 43%, way above Buffett's 5% threshold. So based on recent performance, that's a pass. It shows they can convert revenue to cash effectively now.
Good, a point in their favor. How about growth and predictability? Buffett wants like a 10-year track record of steady, positive earnings per share growth.
Yeah, that's a problem area. It's a fail. Palantir has a history of GAAP net losses. They've only just recently achieved consistent GAAP profitability, so no long, predictable earnings track record there.
But what about shareholder equity?
Good point. On shareholder equity growth, it's actually a pass. Since their direct listing, equity's grown significantly, way faster than 10% compounded annually. Shows they're retaining capital and building the balance sheet.
Okay, mixed results there. Let's look at balance sheet safety. Buffett wants low debt to equity under 0.5 and interest coverage consistently above 3x.
Their balance sheet is rock solid. Debt to equity is basically zero. They have way more cash than debt. Huge pass on low debt. However, because they had operating losses for so long, they didn't consistently meet that 3x interest coverage threshold historically. So it's a fail on the long-term track record for that specific metric, even though debt isn't an issue now.
Right, almost there. Last one, profitability and efficiency. Buffett likes high gross margins, over 40%, high net margins, over 20%, and consistently good return on equity, ROE over 15%, and return on invested capital, ROIC over 12%.
Gross margins, fantastic. Consistently around 80%. Big pass, net profit margin. Well, in Q2 2025, it was 33%, which is excellent. So pass on recent performance. But historically, it was negative. But ROE and ROIC, that's where it falls short again. It's a fail. ROE has been mostly negative, and the TTM figure of around 11.8% is still below Buffett's 15% target. ROIC has also been historically poor. They haven't consistently shown high returns on the capital invested in the business over time.
So let's sum up the Buffett gauntlet. Passes on business quality, high gross margins, good recent cash flow, strong balance sheet. But decisive fails on valuation, historical consistency, and long-term predictable profitability metrics like ROE and ROIC.
Precisely. It really underscores that philosophical gap. And it probably explains why you don't see major value investors holding Palantir. Berkshire Hathaway, Baupost Group, Sign Asset Management.
Yeah.
They're not in it. The current price is likely just too rich, too far removed from their definition of value and safety.
Okay, so if the Buffett tests show it's expensive by value standards, what might its intrinsic value actually be? To get a handle on that, we looked at a discounted cash flow, or DCF, analysis. This tries to estimate value based on future cash flows. We used a 10-year projection, a 10% discount rate, 3% terminal growth, and started with $1.9 billion in FCF, the midpoint of their 2025 guidance.
Right, and we ran three scenarios. First, a conservative case assumes 15% FCF growth for years 1 to 5, then tapering down to 10% for years 6 to 10. That calculation gives an intrinsic value of about $48.55 per share. If you wanted a 25% margin of safety on top of that, your buy price would be around $36.41.
$48 conservative, okay.
Then, a nominal case, a bit more optimistic,
Okay.
25% FCF growth for the first 5 years, tapering to 15% for the next 5. That gets you an intrinsic value of $75.10 per share. With 25% safety margin, the buy price is $56.33.
75 nominal, still far from the current price.
Very far. Finally, an optimistic case, really bullish. 35% FCF growth for 5 years, tapering to 20% for the next 5. Even here, the calculated intrinsic value is $118.23 per share. The buy price, with a 25% safety margin, would be $88.67.
Wow. Okay, so let's put that in perspective. The stock is currently trading around $160 a share. That's significantly higher than even the most optimistic DCF value we just calculated. What does that tell you? Is the market just completely detached from fundamentals here, or is it betting on something truly revolutionary that these models can't capture?
It tells you that from a standard fundamental cash flow perspective, the stock looks significantly overvalued. Hugely, even. The market is essentially pricing in growth rates that are not just optimistic, but astronomically high and sustained for a full decade. It requires near-perfect execution and assumes Palantir basically conquers the enterprise AI world.
So bringing it all together, Palantir really is a story of contrasts, isn't it? You've got this incredibly advanced technology, a business model that's clearly scaling now, showing amazing operating leverage, that rule of 94. But then you have a stock price that seems almost divorced from any traditional sense of fundamental value.
That's the dilemma. The bull case is compelling, no doubt. They're potentially a core platform for the whole enterprise AI shift. They have visionary founders, a strong moat. That operating leverage is breathtaking.
But the bear case is just as strong, maybe stronger for some, and it all comes back to that valuation. It feels priced for years and years of flawless execution, leaving zero room, zero margin of safety for any bumps in the road, competition, recession, anything. It's like walking a tightrope without a net.
So the final thought, maybe the provocative question for you listening is this. Is buying Palantir today an investment based on a deep conviction in the AI future they represent? Or is it about sticking to the discipline of valuing a business based on what you can reasonably quantify today, with a safety cushion? When does an amazing company become just too expensive to be a good investment? How do you reconcile that?
Definitely something to think about. And remember, this deep dive, like everything we do, is based on publicly available information. Interpretations can vary.
Absolutely. This is purely for educational purposes. It is not investment advice. Please always do your own research and due diligence before making any investment decisions.
If you found this deep dive useful and want more insights into value investing, please do like and subscribe. You can find us on Apple Podcasts, Spotify, or our YouTube channel, Deep Value Investing.
And check the episode description. We've put together a list of value investing books if you want to continue your own deep dive. Also, to support us and keep an eye on overall market valuation, you might want to check out the Buffett Indicator iOS app available on the Apple App Store.